Remember the 2023 recession? How did you manage your finances during that time? It was a year marked by a significant contraction in economic activity, a year that saw many of us grappling with the harsh realities of an economic downturn. The signs were there: mass layoffs in certain sectors such as professional and business services, as well as leisure and hospitality, while the real estate rental and educational sectors remained relatively stable. We saw rising rents, interest rate hikes, and high prices, all of which pointed to the looming financial storm. But the 2023 recession didn't just come out of the blue. It was a result of a combination of factors that culminated in a perfect economic storm. The Federal Reserve had increased interest rates to combat inflation, leading to higher mortgage rates and pricing many potential homebuyers out of the market. Food and energy costs saw significant increases, impacting the average consumer's budget. Even retirement savings weren't immune, with the average 401k balance declining by almost a quarter. Businesses, large and small, felt the squeeze. The economy contracted, and companies had to make tough decisions to stay afloat. Many had to lay off employees, while others had to close their doors for good. It was a time of uncertainty, a time when financial stability seemed like a distant dream, but every cloud has a silver lining. In the face of adversity, we saw resilience and adaptability. People started focusing on becoming indispensable at work, networking to secure job stability, and paying off high-interest debts. They built emergency savings, cut unnecessary expenses, and stayed the course with their investments. The 2023 recession was a challenging time, but it was also a learning experience. It taught us the importance of preparation, of having a plan, and of being financially savvy. It reminded us that economic downturns, while difficult, are a part of life, and that we must be ready to weather such storms. Understanding the past is key to preparing for the future. Now let's dive into how to handle finances during a recession. Recessions are a natural part of the economy, but they can be challenging to navigate. So, what exactly is a recession? Generally speaking, a recession is a significant contraction in economic activity that lasts for several months. It is characterized by a decline in gross domestic product or GDP, job losses, slower wage growth, and a decrease in retail sales. Recessions are typically defined by 2 consecutive quarters of negative GDP growth. To put it simply, when the total value of all goods and services produced by a country decreases for 6 months straight, we're in a recession. But remember, it's not just about the numbers. Recessions can have real tangible effects on everyday life. You might see more people out of work, businesses closing, and less money being spent in general. Now you might be wondering, how long do recessions usually last? Well, there's no hard and fast rule. Some recessions are short-lived, lasting only a few months, while others can stretch on for years. For instance, the global financial crisis that began in 2008 lasted for 18 months, the longest period of economic decline since World War II. It's also important to note that recessions are a global phenomenon. They can and do happen everywhere, from the United States to New Zealand. Each country has its own unique economic conditions that can lead to a recession. For example, in New Zealand, a significant increase in the official cash rate led to higher mortgage rates, impacting consumers' ability to spend on discretionary items and pushing the country towards a recession. And let's not forget the recent 2023 recession. Major causes included high interest rates and unemployment rates, along with mass layoffs in certain sectors, rising rents, and high prices. So why is understanding the nature of recessions important? Because it helps us plan and prepare. Just like how we prepare for a storm by understanding its nature and impacts, we can also prepare for economic downturns by understanding what they are, how they work, and what their effects can be. Knowledge about recessions is power. With this understanding, you can make informed financial decisions. Stay tuned as we delve deeper into how to prepare for a recession in our next scene. Preparation is key when it comes to facing a recession. That's something you've probably heard before, but it rings especially true when we're talking about the financial challenges of an economic downturn. So, how do we prepare for a recession? Firstly, it's all about boosting your savings. Think of it as building a financial fortress around yourself. This is your emergency fund, and it's your first line of defense in a recession. The goal is to have enough saved to cover at least 3 to 6 months of living expenses. This cushion can help you weather any unexpected expenses or loss of income during a recession. Next, let's talk about debt, particularly high-interest debt. It's like a leak in your financial boat. The more you have, the faster your boat sinks. So, before a recession hits, it's wise to pay off high-interest debts as much as possible. This reduces your monthly obligations and frees up more of your income to be saved or invested. Now let's discuss employment. A steady paycheck is your best defense against a recession. Even if rumors of a recession are swirling, it's important to secure stable employment. This might involve improving your job skills, networking, or even changing careers. But remember, preparing for a recession isn't just about bracing for impact. It's also about positioning yourself to take advantage of opportunities that may arise. For instance, during a recession, the price of many assets, such as stocks, often falls. If you've been prudent with your savings and debt, you might be in a position to invest and potentially reap the rewards when the economy recovers. In the end, preparation is about more than just surviving a recession. It's about coming out the other side stronger and more financially secure. Just remember, a recession is not a financial death sentence. It's a challenging period, no doubt, but with the right preparation, it's a challenge that can be overcome. Being prepared can make the difference between weathering a recession and being overwhelmed by it. So, let's get prepared. It's time to batten down the hatches, steady the ship, and navigate through the stormy seas of recession. Once a recession hits, how do you manage your finances? That's a question most people grapple with when the economy takes a downward turn. But fear not, there are strategies to help you navigate these tricky times. Firstly, it's important to have a clear understanding of your financial situation. Create a written budget. This is not just a list of your income and expenses, but a plan that helps you prioritize your spending. It's a tool that lets you see where your money is going and where you might need to make adjustments. This is a time to cut back on non-essential expenses and focus on the necessities. Next, avoid making impulsive investment decisions during a recession. It's easy to panic when you see the market fluctuating, but remember, investing is a long-term game. Stick to your investment plan and avoid knee-jerk reactions based on short-term market movements. Another key point is to save money wherever you can. This could mean using coupons or shopping sales for your everyday purchases. Every little bit helps and can add up to significant savings over time. Also, consider paying off high-interest debt. It might seem counterintuitive to focus on debt when money is tight, but the interest on these debts can compound and become a bigger burden down the line. If you can, make a plan to pay these off, starting with the debt with the highest interest rate. Lastly, if you're employed, focus on becoming indispensable at work. This might be a good time to upskill or cross-skill to secure your employment. Networking, both within and outside your current job, can also open up opportunities. Remember, while recessions are challenging, they are also temporary. By managing your finances effectively during a recession, you can set yourself up to come out the other side more financially stable. Managing your finances effectively during a recession can help you come out the other side more financially stable. After a recession, it's important to assess your financial situation and make necessary adjustments. As the dust settles and the economy begins to recover, it's time to look towards the future and navigate the post-recession landscape. This requires a strategic approach, a keen understanding of your finances, and a willingness to make changes where necessary. First and foremost, reassess your budget. The recession may have forced you to cut back on certain expenses or find new ways to save money. Now it's time to look at your spending habits and financial obligations with fresh eyes. Are there expenses you can further trim or luxury items you can live without? Conversely, are there areas where you need to start spending more, such as investments or retirement savings? Your budget is your financial roadmap, and it needs to reflect your current reality. Next, consider reinvesting wisely. A recession often results in a drop in asset prices, presenting opportunities for savvy investors. But tread carefully. The post-recession market can be volatile, and it's important to diversify your investments to spread risk. Investing isn't just about stocks and bonds. Consider other avenues like real estate or even starting a small business. Remember, the goal is to create multiple income streams. Lastly, focus on rebuilding your emergency fund. If you dipped into your savings during the recession, now is the time to replenish it. An emergency fund is your financial safety net. It protects you from unforeseen expenses and gives you the freedom to make smart, not desperate, financial decisions. Post-recession isn't just about recovery. It's an opportunity to learn from the past and build a more resilient financial future. It's about understanding that recessions, while challenging, are part of the economic cycle. They come and they go. What remains constant is our ability to adapt, to grow, and to thrive amidst adversity. Remember, post-recession is a time to rebuild and plan for the future. Let's look at some real-life examples of how these strategies have worked during past recessions. First, we have the story of a small business owner who made it through the recession of 2008. This individual had the foresight to build an emergency fund during the prosperous years preceding the downturn. When the recession hit and revenues plummeted, rather than cutting staff or shutting down, the business was able to lean on this fund to cover expenses until the economy rebounded. Next, consider the case of a family during the same recession. Prior to the downturn, they had prioritized paying off high-interest debts, freeing up a significant portion of their income. When the recession led to job losses, this family was better able to manage their reduced income without the burden of hefty debt payments. Then there's the example of an investor during the recent 2023 recession. Despite the market volatility, this investor stayed the course with a diversified portfolio. Instead of panic selling, they continued to invest consistently, buying more shares at lower prices. When the market eventually recovered, they reaped the benefits of this disciplined approach. Finally, let's look at a professional in the educational sector during the 2023 recession. Despite significant job losses in other sectors, they were able to maintain stable employment due to the relative resilience of their industry. In addition, their networking efforts ensured job stability, providing a safety net in the face of economic uncertainty. These examples show that with the right strategies, it's possible to weather a recession. So, what have we learned about handling finances during a recession? We began by reflecting on the 2023 recession, understanding its causes and effects. We learned that recessions are significant economic contractions that can be triggered by various factors, including high interest rates and unemployment rates. However, they are temporary and a natural part of the economy. Next, we looked into the preparation stage. We discovered that increasing savings, paying off high-interest debts, and creating an emergency fund are crucial steps towards preparing for a recession. We also learned the importance of staying calm and focusing on what we can control, including our spending habits and investment decisions. During a recession, managing finances becomes even more critical. We emphasized the significance of becoming indispensable at work, networking for job stability, and cutting unnecessary expenses. We also tackled the idea of potentially investing in stocks at a lower price point, taking advantage of the economic downturn. After the recession, financial management remains essential. We discussed the need to reassess our financial situation, adjust our budgets, and continue to save and invest wisely. We also highlighted the importance of learning from past experiences and preparing for future economic contractions. Throughout our discussion, we reflected on true examples of recession-proof strategies. These examples reinforced the importance of the strategies we discussed and demonstrated their effectiveness in real-world scenarios. With this information, you're better prepared to face a recession. Remember, knowledge is power. Don't forget to subscribe to our channel for more financial insights.